Hello, everyone. I'm here to discuss the possible ramifications on the economy with the new aid package that passed through Congress recently. It's a $1.9 trillion package, and there's going to be checks written out directly to people as high as $1,400. And there's concerns that this type of stimulus, combined with this monetary stimulus by the Federal Reserve, may cause inflation. And what I'm going to do is I'm going to look at two different scenarios and see what the estimates are for the inflation rate in the United States. Now, what I've done here is I downloaded some data from the BEA, Bureau of Economic Analysis. That's the agency that basically calculates GDP. GDP is the measurement of economic activity, and so that's how we measure the economy, gross domestic product. And what I have here is I have the data at an annual rate. So you can see from 2016 through 2019, the United States economy was growing at somewhere around a 2% growth rate, which is not bad. The United States long run growth rate is estimated to be about 2.5%. That simply means that the US economy can't really grow faster than 2.5% for very long, unless there's a lot of unused resources out there. And so you could see that when COVID hit, 2020 went into negative territory. So the economy in 2020 contracted by 3.5%. Now that's the definition of a recession. A recession is more or less 2 consecutive quarters, or at least 6 months of negative growth. And the entire year for 2020 was indeed negative. Though we had a positive first quarter, the second, third, and fourth were very negative, and it brought the overall annual growth rate to minus 3.5%. Now, come 2021, with a vaccine being rolled out, and with a lot of stimulus, both fiscal stimulus by Congress and monetary stimulus by the Federal Reserve, we have new estimates for 2021. So I'm going to mention one estimate is from an agency called the Conference Board. I have a link to their forecast in the description below. And they have growth at 5.5% estimated for 2021. Now that's remarkable. But they're actually on the low side. There are other estimates from other forecasting agencies as high as 7%. So that's a dramatic turnaround from negative 3.5 all the way in the 5 to 7% range. And I already told you that the long-term growth rate for the US economy is only 2.5%. So that's well above trend. But since there's such unused capacity in the US economy, we can grow at that rate for a year, but it will eventually slow down. The danger is if the US economy grows too fast, too soon, that could cause shortages, which would cause shortages in resources, mainly labor, and that can cause an increase in inflation. Now, the US economy is comfortable at having an annual inflation rate at about 2%. In that range, a little bit above or below 2%, that's considered to be low and stable, and therefore inflation doesn't really have an impact on the economy. It's neither good nor bad. It's neutral. And so the Federal Reserve is going to monitor inflation rate. If the inflation rate gets too high, they're actually going to they will reverse the fiscal stimulus by raising interest rates. And they use a particular measurement for inflation. It's called the PCE expenditure index, and that's similar to CPI, consumer price index, but the Federal Reserve feel it's a little more accurate, and more importantly, they look at the core PCE index. Core simply means that they're going to look at inflation without taking into account food and energy, because food and energy prices are very volatile, and so they look at just the basics. Now, at core, the Federal Reserve would be happy at around 2%. So Let me show you what I've done here is let's use this drop down menu. I did this in Excel, and let's look at the lower growth rate estimate of 5.5% and what the Conference Board predicts inflation will be at that growth rate. So if I do this, you can see the economy jumps at 5.5% growth, and the Conference Board estimates that inflation will increase to 2.2%. Now, that is within the tolerance level of the Federal Reserve. So, in other words, the Federal Reserve wouldn't do anything to counteract the fiscal stimulus if the economy grew at 5.5%. Well, what if the Conference Board is incorrect and it's not at 5.5%? What if the economy grows at 7%? So I have this as the upper range for growth for 2021. If I do that, growth jumps to 7%, but the estimated increase in inflation only goes to 2.5%. So from 2.2 to 2.4. So when you look at the lower range, the economy only growing at 5.5%, estimated inflation will be 2.2%. If it actually accelerates even more and goes at a whopping 7%, that's not going to have an estimated impact, much of an impact on inflation. So in either instance, the Federal Reserve will hold steady, keep their stimulative approach, and not try to counteract the fiscal stimulus. So that's an interesting take, where inflation is really off the table if you believe these estimates from the Conference Board. So it looks like we're in for a robust 2021, and the Federal Reserve doesn't really see inflation to be a big problem if these estimates for inflation hold true. Okay, hope this is helpful. That's all for now.